Welcome to the High Yield Real Estate Investing Podcast, a podcast focusing on multifamily investing in short, easy-to-digest 5-minute segments.
Hi, I'm Brooke.
And I'm Dan. When learning how to acquire and operate your first rental property, the terms thrown around to evaluate a rental property can get jumbled up in your head with the alphabet soup of all the financial acronyms. Let's take a look at what you need to know to perform these calculations and what each calculation tells us. Luckily, if you remember anything from your third grade math class and own a calculator, you can perform these calculations easily.
Let's talk about residential property calculations. Cash flow. Possibly one of the most important of them all. Your cash in from rents and bank account interest minus cash out, operating expenses, debt payments, capital expenditures over a selected period of time equals your cash flow expressed in a dollar amount. Usually you'll want to know what your cash flow is for an entire year at a time. If you own a checking account, you understand this concept already. Ideally, this is what you get to put in your pocket each month, quarter, or year. If you want to retire using real estate, then this is how you do it.
Rent to value. Here's one you don't even need a calculator for. This is mostly a rule of thumb to help you quickly evaluate if a property has a chance of cash flowing or not. If you've heard of the 1% rule, then this is it. If we want to buy a property for its cash flow, then we want the total possible rent you can collect each month to be at least 1% of the purchase price, ideally more. A quick example, a $400,000 property needs to bring in at least $4,000 a month in rent. Again, 1% is just a rule of thumb. Ideally, you want closer to 1.5%.
Return on investment, also known as ROI. There are a few ways to go about this one. If you own your property with a mortgage, then we'll want to add the principal portion of your mortgage for the entire year to your cash flow for the year. Then divide by the total amount of cash you've invested. However, let's say that you flip houses. You'll want to know your ROI when you sell. So we'll take our forecasted sales price minus the purchase price and rehab expenses divided by our cash invested. ROI is expressed as a percentage.
Now on to commercial properties. Everything we talked about in residential applies, plus the following. Net operating income, or NOI. This is one of the most important numbers for your property. Its value will increase and decrease by this number. If you've heard the expression about something improving the bottom line, they're talking about NOI. We calculate our NOI, usually in 1-year increments, by taking our total income collected and subtracting all of our operating expenses. Notice the mortgage and income taxes are excluded. The NOI purely gives us an idea of what the property itself can do. After all, not all mortgages are the same and everyone pays a different amount for income tax.
Capitalization rate, or plainly, cap rate. This number combined with our NOI will give us the value of our commercial real estate. Remember, residential real estate is valued by its comparables, and cap rate doesn't apply to the residential realm. The cap rate is determined by the market as a whole, and we express it as a percentage. A really fancy Class A property might trade at a high 2 cap, and a war zone property in gang territory might trade at a low 15 cap. To calculate our cap rate, we take net operating income and divide by the property's current market value. Easy, right? But what if we made improvements to our property? The NOI would go up, and we need to figure out what our property is now worth. Just take your NOI and divide it by the cap rate percentage. For example, $25,000 in NOI divided by 0.08 for an 8% cap rate. That gives us an increase in property value by $312,500.
Cash on cash, the ratio between the yearly cash flow, which we already mentioned, and your capital invested expressed as a percentage. It's purely a performance indicator of the cash you use to buy the property and how well it puts money in your pocket. There isn't one specific number I can tell you to look for here. Consider some variables. If you buy a property in all cash, your cash on cash return will be much lower than if you buy with 25% down and a mortgage. Also, let's say you buy with no money down, then your cash on cash would be infinite. If you bought a very nice property and are mostly going for an appreciation play, your cash on cash would be lower than if you bought, say, a Class C apartment complex in the Midwest and are going for cash flow.
Internal rate of return, or IRR. This is probably the most sophisticated calculation of all the ones we've discussed. The IRR allows us to forecast our cash flows and future sales price, then condense it all down into one number expressed as a percentage. Let's say you buy an apartment complex. Plan to make improvements and increase the rents as you do so. You fully expect to increase your cash flows every year as you renovate and also realize a much higher sales price in the future since you've improved the property. This calculation is how we turn all of that into one number. If you want to calculate this, use Excel or a fancy property analyzer. If you're getting 15% or above, you're doing awfully well.
Okay guys, I know we just went through a bunch of math without actually showing you the equations, so don't feel bad if you have to go through this episode a few times to wrap your heads around it. If you're a visual learner like I am, just do a simple Google search for any of the equations contained in this podcast.